Swayam Prabha. Digital India. Educated India.
Yogah Karmasu Kaushalam.
Hello everyone, hope you all are doing well. My name is Dr. Chetna Marwadi. I am working as an assistant professor at SD School of Commerce, Gujarat University, Ahmedabad. Today in this session, we are going to understand about an introduction to costing on the subject of cost accounting. Objectives of this module are: number 1, to know the need of cost accounting through limitations of financial accounting. Number 2, to know the basics of costing, cost accounting and cost accountancy. Number 3, to understand the advantages of cost accounting. Number 4, to understand difference between financial accounting and cost accounting. And number 5, to understand difference between cost, expense and loss. Number 6, to understand various cost concepts. Introduction. Accounting is a branch of social science. Thus, accounting is highly influenced by social changes and making changes as per the need of society. Several accounting branches are developed over a period of time, like financial accounting, cost accounting, management accounting, inflation accounting, human resource accounting, tax accounting, social accounting, environmental accounting, etc. Each branch has its own utility and limitations. 3 branches of accounting are widely used, which are financial accounting, cost accounting and management accounting. Amongst all these branches of accounting, financial accounting is the oldest branch of accounting. In financial accounting, focus is given to profitability computation and measurement of financial conditions of the business, and it deals with historical data of respective financial year. The legitimate need of financial accounting is very high, still it has certain limitations. Now we will discuss limitations of financial accounting, which are: number 1, discloses consolidated results of the business. No product wise or process wise or department wise cost is available, but it is providing only total result. Number 2, deals with historical information. Results of past are disclosed and absence of futuristic information. Number 3, lack of performance appraisal. In this accounting, no arrangement is available for any kind of performance appraisal. It means measurement of any kind of efficiency is not part of financial accounting. For example, material cost is reduced with efforts of purchase and production manager, which is not reflected in this accounting. Number 4, no arrangement for material cost control system. In many business units, material cost is more than 80% of total cost. In such a situations, material control system is inevitable. Unfortunately, financial accounting is silent about it. Number 5, no arrangement for labor cost control system. During operations, different types of losses pertaining to labor take place, like normal loss, abnormal loss, etc. Neither loss measurement nor control system is existed in financial accounting. Number 6, no scientific classification of cost. Total cost is influenced by direct cost, indirect cost, controllable cost, non-controllable cost, etc. But financial accounting has no such classification. Number 7, no analysis of losses. Happening of losses is very obvious in any system. In business, there are expected losses, known as normal loss, unexpected loss known as abnormal loss, capacity loss, efficiency loss, etc. But identification of such losses, ascertainment of causes for such losses is not possible under financial accounting. Number 8. Insufficient information for price determination. All costs pertaining to product or services are not precisely obtainable, thus accurate price determination is not feasible. Due to limitations of financial accounting, new branch of accounting, that is cost accounting, has emerged. The use of cost accounting is not confined to past information, but it deals with future needs. Cost accounting provides detailed cost related information to the all levels of management. The information provided by the cost accounting helps management to take appropriate decisions for profitability enhancement. In this unit, we will study number 1, meaning, objectives and advantages of cost accounting. Number 2, difference between cost accounting and financial accounting. Number 3, cost concepts and classification. Number 4, elements of cost installation of a costing system. Number 5, role of cost accountant in an organization. Now, let's understand cost accounting in chronological order. First, let's see the meaning of costing, cost accounting and cost accountancy. The meaning of costing. Costing is a process to determine cost of a product or a service. The Chartered Institute of Management Accountant UK has defined costing as the techniques or processes to ascertaining cost. Meaning of cost accounting. Cost accounting is a formal system of accounting where determination of cost and cost control is done on the basis of nature of product or service. For example, for cost determination of transport service, operation costing is used. For chemical industry, process costing is used. Meaning of cost accountancy. Cost accountancy is a very wide term. It explains the philosophy of cost and cost accounting. It includes principles, techniques, auditing of cost systems which are employed in business to plan and control the utilization of resources. In brief, financial accounting deals with historical data, means past events, while cost accounting deals with planning and controlling of business activities. Every concept is developed to serve specific purposes and to perform predetermined functions. Purpose and functions of cost accounting are: number 1, determination of cost. For cost determination, elements like material, labor, overhead, etc. are required, and cost accounting covers inclusion of all these elements. Number 2, cost control mechanism. The enhancement in profit can be done through cost control and cost reduction, and that mechanism is provided by cost accounting. Number 3, helpful for managerial decision. Financial accounting is also useful to take managerial decisions, but cost accounting has quality to take accurate and precise managerial decision due to consideration of estimations. Number 4, estimation of selling price. In this competitive world, to sustain own existence, every business unit must decide selling price which is accepted by the targeted customer group. This process is inherent quality of cost accounting. To understand the utility of cost accounting, let's discuss benefit of cost accounting in the form of advantages. Now we will discuss advantages of cost accounting. Cost accounting provides benefits to different stakeholders like workers, organization itself, to the society, to government and to others. Benefits of cost accounting in brief are: number 1, cost accounting disclose information about profitable and non-profitable activities of the businesses. Number 2, its effective use gives benefit of cost reduction and cost control. Number 3, due to cost accounting, precise and correct managerial decisions can be taken. Number 4, it helps to decide very rational selling price during the time of competition and in the competitive world. Number 5, several material controlling techniques are developed under the cost accounting which helps to manage inventory at ideal level. Number 6, policy making decisions cannot be taken only with the help of historical data, and estimated data is provided by cost accounting which makes policy decision very rational, feasible and profitable. Number 7, it is not necessary that all businesses all the time are working at 100% production capacity. So, information about unused capacity is very much essential, and this can be used for special order, and this is possible due to cost accounting only. Number 8, cost accounting brings cost audit, and cost audit prevents fraud and manipulations, and so that management will get correct and reliable information for decision making. Since you all are very well acquainted with financial accounting, here some important differences are discussed so that you will have clear understanding to know cost accounting in better way. Now let's discuss difference between financial accounting and cost accounting. Number 1, first point of difference is aim of accounting. Under financial accounting, the main objective is to know profitability status and financial condition of the business through profit and loss account and balance sheet. Under cost accounting, the main objective is to provide detailed information about cost to the management. Second point of difference is of users. Internal and external users are using financial accounting for their investment decision, whereas it has only internal purposes. It means cost accounting is used by management for future related decision. Third point of difference is of legal provision. Under financial accounting, the preparation of financial accounts is mandatory. Provisions of Companies Act, Income Tax Act, SEBI and ICAI are to be followed because the interest of external stakeholders is involved. Under cost accounting, the Government of India has mandated the maintenance of cost records and cost audits under Section 148 of Companies Act 2013. The relevant acts, rules, provisions with regard to cost records, maintenance or cost audit or production of these documents before statutory authorities are parts of cost accounting. Fourth point of difference is result of cost and profit. Under financial accounting, it discloses only profit, that is excess of revenue income over revenue expenditure. No cost is disclosed for individual product, department or process, whereas under cost accounting, the cost of individual product, department or process is disclosed and ascertainment of profit is also possible. Fifth point of difference is reporting period. Generally, reporting period is of 1 year, and that is usually financial year from 1st April to 31st March of next calendar year under financial accounting, whereas under cost accounting, reporting period is continuous process and it may be daily, weekly, monthly, etc. depending upon the requirement of business entity. Sixth point of difference is control element. Under financial accounting, emphasis is given to record data. No mechanism of control system prevails except financial audit, whereas under cost accounting, the control system is inherent feature of cost accounting. It deals with identification of variances and their remedies. Number 7, point of difference is historical cost and estimated cost. Under financial accounting, it is dominated by historical cost and no room for estimation under financial accounting, whereas under cost accounting, it deals with both historical and estimated cost, and it is very used for policy planning and strategies development. Next point of difference is presentation format. Under financial accounting, the compliance of different acts and legal provisions brings existence of predetermined format. Due to this, accounting information can be compared. In brief, most of the financial statements have their predetermined format, whereas under cost accounting, it has varied forms of cost information. For example, single output costing, operating costing, job costing, etc. Ninth point of difference is nature of transactions. Under financial accounting, only external transactions like purchase of raw material, sale of machinery, goods sold on credit, etc. are dealt with, whereas under cost accounting, external and internal transactions are recorded. For example, departmental transfer of goods, labor, etc. are recorded because here product wise or process wise cost is ascertained. Now, the next topic is about cost, cost concept and cost classification. Here, we will acquire information about cost and cost classification. This cost classification is very important for cost determination. It has high relevance in the field of cost accounting. Every concept has its own terminologies, and thus understanding of these terminologies in the given context becomes essential. Meaning, there are mainly three branches of accounting, namely financial accounting, cost accounting and management accounting. These branches are emerged from the continuous research in the field of accounting. Each branch has different role to play. Their definition, features, process, purposes, scope, etc. are different from each other. But to some extent, the dependency of cost accounting and management accounting is on financial accounting. Definitions. The dealing of financial accounting is with historical information, while cost accounting mainly deals with cost estimation and management accounting deals with managerial decisions. CIMA defines cost accounting as the establishment of budgets, standard cost and actual cost of operations, processes, activities or product, and the analysis of variances, profitability or the social use of funds. Cost accounting accounts for the cost of a product, a service or an operation. It is concerned with actual cost incurred and the estimation of future cost. Cost accounting establishes budgets, standard cost and actual cost. Cost accounting is a set of procedures used in refining raw data into usable information for management decision making, for ascertainment of cost of product and services and its profitability. Cost accounting is a management information system which analyzes past, present and future data to provide the basis for managerial decision making. Prior to understanding different aspects of cost, let's understand precise meaning of cost, expense and loss. Generally, these three are used as synonymous of each other, but they have separate meaning from the viewpoint of accounting. Now, let us discuss the difference between cost, expense and loss. These three terminologies are used as synonym of each other. Practically, these three have different meaning and are used in different contexts. Meaning of cost. Cost may be defined as the amount of expenditure incurred on or attributable to a given thing or to ascertain the cost of a given thing. Cost represents the resources that have been or must be sacrificed to attain a particular objective. Sacrifices may be direct or indirect. Cost can be actual or notional. In financial accounting, notional cost has no place, but cost accounting considers it. For example, rent of own premises which is actually not paid, it is not recorded in financial accounting because it is notional expense, but it will be recorded in cost accounting for cost determination. Meaning of expense. Expense refers to cost or expenditure which appears in the profit and loss accounts of a given period as deduction or matched against the revenue in order to arrive at profit or loss of that period. It represents sacrifice of resources for economic benefit. Expenses is recorded in profit and loss account, hence it cannot be notional. Only actual paid or unpaid expenses of that respective period are recorded. For example, rent paid on office premises and unpaid rent of office premises are actually incurred, hence are expenses. Meaning of loss. Loss refers to the amount of difference between the expenses and revenues when expenses exceed revenues for an accounting period. For example, sales is of rupees 10,000 and cost is rupees 11,000. Difference is rupees 1,000. It is treated as loss. Another meaning attributable to loss is that it is opposite of a gain. That is, a loss related to the net effect of an unfavorable transaction, event or situation. If it can be established that there is no matching economic benefit for expired cost, it is referred to as loss. For example, book value of asset is of rupees 50,000 and it is not useful and sold for rupees 40,000. The difference of rupees 10,000, it is loss. Now, let us see concepts of cost accounting. Cost concepts. Different types of cost concepts are used in cost accounting and having specific meaning and interpretation. Thus, the clear understanding of various cost concepts is essential for the study of cost accounting and cost systems. These concepts has vital role for cost determination. First concept is product and period cost. Product cost is the total of costs that are related with a unit of product. Such cost may or may not include an element of factory overhead, and it is depending upon the type of costing system in force. It can be either absorption, that is total, or direct, that is variable or marginal cost. Product costs are related to goods produced or purchased for resale and are initially identifiable as part of inventory. These product or inventory cost become expenses in the form of cost of goods sold only when the inventory is sold. Product cost is associated with unit of production. The product cost includes direct material, direct labor and factory overhead. Inventory valuation is done on the basis of these costs. Under variable costing system only, factory variable overheads are included, and under absorption costing, both factory fixed and factory variable cost are considered. Period cost. Period cost has relation with specific period of time. The period cost is not affected by changes in the level of activity during a given specific period of time. Period cost is concerned with time period rather than manufacturing action, and these costs are deducted as expenses during the current period without previously classified as product cost. Period costs are being deducted as expenses during the current period without having been previously classified as product cost. Administration and selling and distribution cost, for example, office rent, godown rent, depreciation on office related assets are period cost and are deducted from the revenue without their being regarded as the part of inventory cost. These cost has no relation with inventory cost. Next concept is common and joint cost. The common cost is an indirect cost, includes factory, administration and selling overhead, that is incurred for the general benefit of a different departments or for the entire organization, and which are necessary for present and future activities. For instance, you can derive kerosene, fuel oil, gasoline from crude oil. Common cost arises when a firm produces outputs several products. For example, a production manager's salary is a common cost. You can distribute it between several manufacturing process, but it's not related to any of them. Joint cost. Joint costs are the cost of either a single process or a series of processes that concurrently produce two or more products of significant relevant sales value. For example, total gallons of 1,10,000 milk is introduced in the process for rupees 40 lakhs, and from this 25,000 gallon cream and 75,000 gallon liquid scheme are produced. So, here rupees 40 lakh is the joint cost of cream and liquid scheme. Next concept is past and future cost. Past costs are the costs that are actual costs incurred in the past and are generally disclosed in the financial accounts. These costs are also known as historical cost. This cost is irrelevant for decision making. These costs will just act as a direct cost for future course of action. For example, a machine of rupees 5 lakh was purchased during last financial year. This machine cost is historical cost for current year and would appear in balance sheet. Future cost. Future costs are costs expected to be incurred at a later date and are the only costs that matter for managerial decisions because they are subject to management control. These costs has great influence on managerial decisions. Future costs are relevant for managerial decision making like cost control, profit projections, appraisal of capital expenditure, introduction of new products, expansion program and pricing, etc. For example, company is working at 80% production capacity and it receives an order for another 30% capacity. A company has idle capacity of 20% and the order is of 30%. In this case, if company wants to accept this order, the company will have to incur cost for remaining 10%. The cost for this 10% is future cost. Next concept is replacement and historical cost. The replacement cost and historical cost are two methods for balance sheet disclosure purpose. Replacement cost is a cost at which material or assets identical to that is to be replaced could be purchased at the date of valuation. The replacement cost is a cost of replacing an asset at any given point of time, either at present or in future, other than improvement cost. Historical cost. Historical cost is the real, that is actual cost determined after an event. Historical cost valuation states cost of a plant and materials which is paid by the entity to acquire respective asset. Next concept is imputed and sunk cost. Imputed cost. Imputed cost is known as an opportunity cost also. An imputed cost have no relation with cash outflow. These are used only for the purpose of decision making and performance evaluation. Imputed cost is a hypothetical cost from the point of view of financial accounting. Rent on own premises and interest on capital is common type of imputed cost. No actual payment of interest is made, but the basic concept is that had the future fund been invested elsewhere, they would have earned interest. Thus, imputed costs are a type of opportunity cost. Sunk cost. The sunk costs are historical costs. The sunk costs are those costs that have been invested in a project and which will not be recovered if the project is terminated. The sunk cost is one for which expenditure has taken place in the past. This cost is not affected by a particular decision under consideration. Sunk costs are always results of decision taken in past. These costs cannot be changed by any decision in future. Investment in plant and machinery, as soon as it is installed, its cost is sunk cost and is not relevant for decision. It is important to understand that an unavoidable cost may not be a sunk cost. The managing director's salary is generally unavoidable and also out of pocket, but not sunk cost. For example, the company is working at 80% production capacity and receives an order for another 20% capacity. A company has idle capacity of 20% and the order is also of 20%. In this case, if company wants to accept that order, the company will have to incur no cost for remaining 20% capacity. This is its sunk cost. Next concept is relevant and irrelevant cost. The relevant cost is such a cost which has importance for managerial decision making. It is future cost. It is to be incurred in cash in future. Business decisions involve planning for future and consideration of several alternative courses of action. In this process, the costs which are affected by the decisions are future costs. Such costs are called relevant costs for that respective project. For example, where a company intends to rearrange production facilities, the estimates of true cost are direct material cost per unit. Suppose for the existing facility is rupees 100 and for the proposed rearrangement is also rupees 100, and direct labor cost per unit for the existing facilities is rupees 50 and for proposed rearrangement it is rupees 40. There is no change in material cost, thus it is irrelevant to the decision. Due to change in decision, the labor cost would change, thus labor cost is relevant cost. The next concept is opportunity and incremental or different cost. The opportunity cost is the value of a benefit sacrificed in favor of an alternative course of action. The opportunity cost of a good or services is measured in terms of revenue which could have been earned by employing that good or service in some other alternative uses. The opportunity cost can be defined as the revenue foregone by not making the best alternative use. The opportunity cost is the prospective change in cost following the adoption of an alternative machine process, raw material, etc. It is the cost of opportunity lost by the diversion of an input from use to another. Let's understand this concept with the help of illustration. The following information pertains to the recent financial year for Rajesh International Limited. Revenue given is of rupees 3,50,000 less cost given are raw material cost rupees 1 lakh, electricity cost rupees 25,000, salary and wages rupees 30,000, interest rupees 5,000, hence total cost amount to rupees 1,60,000. Apart from the above expenses, Mr. Rajesh, the proprietor of Rajesh International Limited, invested in the business own fund amounting to rupees 80,000 per year and also took to pay a reduction of rupees 30,000. Based on the above facts, we can observe that accounting profit is equal to revenue minus expenses. Here, revenue given is rupees 3,50,000 and expenses given are rupees 1,60,000. Therefore, accounting profit is rupees 1,90,000. However, after adjusting for opportunity cost, economic profit will be different than accounting profit, which is shown as below. Economic profit is equal to accounting profit minus implicit or opportunity cost. Here, accounting profit is of rupees 1,90,000, whereas our opportunity cost is of rupees 80,000, that is own investment, plus rupees 30,000, which is a pay reduction of Mr. Rajesh, thus coming to economic profit of rupees 80,000. Incremental or differential cost. The incremental cost is the extra cost due to managerial decision. It is also known as differential cost. The incremental cost is the additional cost due to change in level or nature of business activity. The change may take place in several forms. For example, changing the channel of distribution, adding a new machine, replacing an existing machine by a better machine, execution of export order, etc. Incremental cost will be different in case of different alternatives. Hence, incremental costs are relevant to the management in the analysis for decision making. Let's take an example to understand this better. Assuming a manufacturing company, Bharat Limited, has a production unit where the total cost incurred in making 100 units of a product X is rupees 2,000. The company wants to add another product Y, for which it incurs some cost in terms of salary to the additional labor force, raw materials, and assuming that there is no additional fixed cost. Let's suppose now after adding the new product line, it is able to produce 200 units at rupees 3,500. So, here the incremental cost is rupees 1500. For 100 units, total cost is rupees 2000 and per unit cost comes to rupees 20. For 200 units, total cost is rupees 3500 and per unit cost comes to rupees 17.50. It is not necessary that such cost can only be variable in nature. Even fixed costs can contribute to incremental cost. For example, if there is a requirement of new machinery altogether for adding the new product line Y, then it is incremental fixed cost. Next concept is conversion cost. The conversion cost is the cost incurred for converting the raw material into finished product. It is referred to as the production cost excluding the cost of direct materials. We will understand this cost with the help of an illustration. Conversion cost is equal to direct labor plus manufacturing overhead. Say for example, direct labor expenses given are rupees 50,000, depreciation on machinery rupees 6,000, insurance expenses rupees 12,000, maintenance expenses rupees 6,000, electricity rupees 14,000. The conversion cost for company A will be direct labor plus maintenance expenses, insurance expenses, electricity expenses, which equal to direct labor given in the example is rupees 50,000 plus maintenance expense given is rupees 6,000, insurance expense given the conversion cost for company A will be direct labor plus depreciation expenses plus insurance expenses plus maintenance expenses plus electricity charges. Direct labor given in the example is rupees 50,000, depreciation expense given is rupees 6,000, insurance expense given is rupees 12,000, maintenance expense given is rupees 6,000 and electricity charges given is rupees 14,000. Thereby, our total conversion cost for company A will be rupees 88,000. The next concept is shutdown and abandonment cost. The shutdown costs are the cost incurred in relation to the temporary closing of a department, division or enterprise. Such costs include two types of costs. Number 1, those costs of closing as well as number 2, those costs of reopening. The shutdown costs are defined as those costs which would be incurred in the event of suspension of the plant operation and which would be saved if the operations are continued. Examples of such costs are cost of sheltering the plant and equipment and construction of sheds for storing exposed property. Further, the additional expenses may have to be incurred when operations are restored. For example, re-employment of workers may involve cost of recruitment and training. Given illustration will be useful to understand this cost. As an example, consider the situation of a yoga center which has signed a contract to rent space that cost rupees 10,000 per month. If the firm decides to operate, its marginal cost for hiring yoga teacher is rupees 15,000 for the month. If the firm shut down, it must still pay the rent, but it would not need to hire the yoga teacher. So, shutdown cost is rent of rupees 10,000. Marginal cost. The marginal cost is the variable cost of one unit of a product or service. That is a cost which would be avoided if the unit was not produced or provided. In this context, a unit is usually either a single article or a standard measure such as liter or kilogram. The next concept is notional cost. The notional cost is a hypothetical cost taken into account in a particular situation to represent the benefit enjoyed by an entity in respect of which no actual expense is incurred. For example, Mr. Kant is running own factory in rented premises. This rent is actual cost. if Mr. Kant runs his business in own premises and the charging rent, it is notional cost. In this module, we have studied different aspects of cost accounting, which are number 1, need of cost accounting due to limitations of financial accounting. Number 2, difference between financial accounting and cost accounting, which is important aspect to understand utility of cost accounting, is covered here. Number 3, meaning of costing, cost accounting and cost accountancy to avoid any kind of ambiguity for these terminologies. Number 4, what kind of purposes are served by the cost accounting. This is also discussed in this module. Number 5, how cost accounting is beneficial to different stakeholders. It is also studied in this module. Number 6, cost concepts are also discussed in this module, and these concepts explain the specific meaning of terminologies of cost accounting. In the second module of Unit 1, we will study about number 1, classification of cost, number 2, role of cost accountant to make cost accounting effective and efficient, number 3, installation of costing system so that maximum benefit can be obtained by using cost accounting in the businesses. I hope you all have got a clear understanding of what is cost accounting and its basic. Thank you everyone for watching this.